Okay, so after spinning off its massive healthcare business, settling these multi-billion-dollar lawsuits, and bringing in a brand new CEO, is the new 3M a coiled spring, finally ready for a massive comeback? Or is this industrial titan still kind of navigating a labyrinth of deep systemic challenges? We're going to try and get to the bottom of this today, and by the end of this deep dive, you'll have a much clearer picture of what the market might be missing, or maybe what it's already got right regarding 3M's current valuation, especially when we compare it to our intrinsic value estimate. Welcome to the deep dive, where we take your sources, the articles, the research, the data, and really extract the most important insights, giving you that shortcut to being truly well informed. Today, we're doing a deep dive into 3M Co., trading on the NYSE under the ticker MMM.
Exactly. Our mission today is to explore 3M's core business, evaluate its new management, really dissect its financial health, and uncover the critical risks. We're doing this through the lens of a disciplined value investor, aiming to understand its true intrinsic value. And just so you know, all of our analysis is anchored to June 24th, 2025, with the closing share price sitting at $142.51 as of June 20, 2025.
This should be a really fascinating journey into a company that, well, it really defines American industry in many ways. Let's jump straight into Chapter 1, Business Analysis, the science behind the stock. So let's unpack this industrial titan's core business. For those who might just think 3M makes Post-it notes, what is 3M truly all about?
Yeah, you're right. It's far more than just Post-its. At its core, 3M's entire model is built on relentless scientific innovation, really. They're leveraging over 45 distinct technology platforms, constantly, cross-pollinating ideas across different applications. Their value proposition isn't about being the cheapest. It's about creating critical, high-performance, often indispensable solutions for their customers.
And since their big healthcare spinoff, Solventum, back in April 2024, has that focus sharpened even further?
Oh, absolutely. The new 3M is definitely leaner and more focused. They now operate primarily through three main segments. The largest is safety and industrial. That brought in $10.96 billion in fiscal year 2024, so about 45% of their total revenue.
Okay, 45%.
Then we have transportation and electronics. That's at $8.38 billion, representing 34% of revenue.
Yeah.
And finally, the segment most familiar to, well, all of us, consumer, at $4.93 billion, or 20% of revenue.
Right. When you talk about 60,000 products, though, it's truly staggering. Beyond the consumer staples we all know, what are some of those critical, almost invisible products that are essential to other businesses?
It's incredible how embedded they are, really. In safety and industrial, think about N95 respirators, obviously critical during the pandemic, right? But also just essential in hazardous industrial environments day to day. Then there are specialized industrial adhesives like 3M VHB tapes. I mean, these things are so strong they actually replace rivets in some applications. Or abrasives like Cupitron. In transportation and electronics, they make specialized films for smartphone displays, maybe the very screen you're looking at right now. They're supplying materials for EV batteries, which is a huge growth area, obviously, and even the highly durable reflective sheeting for road signs you see every single day.
So their products are literally everywhere. What does this massive footprint and this innovative drive really mean for 3M's market position and its overall value proposition in the industrial landscape?
It means 3M is a true global behemoth, almost unparalleled reach. They operate in over 70 countries, have manufacturing facilities in 29, and sell their products in nearly 200 markets worldwide.
200 markets?
Yeah. This isn't just another company, it's a blue-chip leader. It's part of both the Dow Jones Industrial Average and the S&P 500. They've got 61,500 employees and a market cap of $76.7 billion.
Their mission, to apply science to improve lives, I think perfectly sums up their value proposition. It's innovation, quality, and reliability for those mission-critical components their customers absolutely depend on. Okay, given that immense scale, what are management's key priorities right now, in terms of industry trends and where they see growth coming from?
Management is strategically focusing on several high-growth areas, things like automotive electrification, industrial automation, general safety solutions, and home improvement. They're targeting, well, modest organic sales growth of 2% to 3% for 2025, which honestly for a company of this size indicates a renewed focus on, getting that top line expanding again. They're also heavily ramping up product innovation with a pretty ambitious goal of launching 1,000 new products in just 3 years.
1,000, wow.
Yeah, this isn't just about making new things. It's about signaling a return to their innovative roots, I think.
That makes sense. But even with their scale, they're not alone out there. Who are their main competitors in these diverse industrial sectors?
No, definitely not alone. They face intense competition from other diversified industrials. The big names, Danaher, Honeywell, DuPont. It's interesting to note that while 3M boasts higher revenue, Danaher is often viewed more favorably by analysts.
Why is that, do you think?
Well, it suggests the market might be valuing something beyond just scale, perhaps growth potential, or maybe operational efficiency. It's
Yeah.
hard to say for sure. And speaking of challenges, the most significant regulatory hurdle, the one that's dominated headlines for years, is the issue of PFAS forever chemicals.
Right.
3M has publicly committed to exiting all PFAS manufacturing by the end of 2025. That's a direct consequence of extensive litigation and those multi-billion-dollar settlements.
That PFAS commitment is huge. But even with those challenges, 3M has persisted for decades.
Yeah.
What are their unique competitive advantages? What creates these high barriers to entry that protect their business from rivals?
The barriers here are truly, truly formidable. It creates a deep moat around their business. First, there's their immense intellectual property, over 125,000 active patents. That's the culmination of decades, and an estimated $100 billion in R&D investment. It's not just patents, it's proprietary knowledge. Then, the sheer capital requirements needed to compete at this scale are immense. 3M alone invested $1.9 billion in R&D in 2023. You also have their brand recognition. It's iconic. Post and Scotchy aren't just brands, they're category-defining, almost synonymous with the product itself. They benefit from massive economies of scale, with over 100 manufacturing facilities globally. That provides significant cost efficiencies. In the crucial B2B space, switching costs are incredibly high because 3M products are often spec-in components, meaning they're so integrated into a customer's design or manufacturing process that replacing them would be incredibly disruptive and expensive.
Ah, I see.
And finally, perhaps their most unique asset is a deeply ingrained culture of innovation and R&D, one that constantly cross-pollinates ideas and solutions across their 45-plus technology platforms. That kind of institutional knowledge, that collaborative environment, it's almost impossible to replicate.
It's clear their competitive advantages run deep. Let's move on to Chapter 2, Management Evaluation, Steering the Industrial Supertanker. We mentioned a new CEO. What's the story behind William Vilbrown's appointment, and what does it signal for 3M's future?
Yeah, his appointment as chairman and CEO on May 1st, 2024, was a hugely significant move, primarily because he was an external hire.
Right, not an insider.
Exactly. And that signals a clear desire for fundamental, perhaps even dramatic change within the company. His track record is highly relevant, too. He led a complex merger at L3Harris Technologies, spent 14 years at United Technologies. That experience is crucial for 3M right now. They need operational streamlining, a new performance-driven culture post-spinoff. He's not coming in to simply maintain the status quo.
That makes sense. But speaking of past challenges, 3M's ethical reputation has been under intense scrutiny because of those massive lawsuits. How transparent are they now, and how do we reconcile their stated ethical commitments with those historical issues? It feels like a bit of a disconnect.
It's a very complex picture, truly a paradox. On one hand, they maintain formal transparency. Robust investor relations, SEC filings, press releases. Ethically, they've been recognized by Ethisphere as one of the world's most ethical companies for 10 consecutive years. They have a detailed code of conduct. That's a strong public commitment.
10 years is a long time.
It is. However, this stands in stark contrast to the massive financial and reputational consequences they've faced from past PFAS and combat arms earplugs issues, multi-billion-dollar costs. The challenge for management now is to transparently confront and settle these legacy issues while at the same time rebuilding trust and demonstrating that these are past problems, not ongoing ones. It's a difficult balancing act.
You touched on it earlier, but how has 3M's capital allocation strategy been fundamentally reshaped after all these major shifts, the spinoff, the litigation? How are they spending their money now?
It's undergone a complete overhaul, really. Top priority now is organic growth. There's a clear commitment to dedicating 6% of sales to R&D.
Okay, 6%.
The Solventum spinoff wasn't just a divestiture. It was a deliberate portfolio move to create two more focused, more agile companies. Historically, 3M was pretty active in M&A, but that's been muted recently. They're prioritizing internal investment and, well, resolving those legal liabilities. Looking forward, their 2025 Investor Day presented a more balanced approach, investing aggressively in the business while still committing to return a minimum of $10 billion to shareholders in the medium term.
$10 million. Okay. Shareholder returns, especially that famous dividend, used to be 3M's hallmark, right? What's the situation now with share buybacks and that payout?
It's certainly undergone a dramatic transformation, and I think a necessary one. After making $1.8 billion in buybacks in 2024, they authorized a new, larger $7.5 billion share repurchase program in February 2025. So that shows some confidence.
Right.
But the biggest change was the dividend. For decades, 3M was a dividend king, a true investor darling, always increasing its payout.
Yeah, I remember that.
That legacy unfortunately ended in 2024. The quarterly payout was cut significantly from $1.51 down to $0.70, though it did see a modest increase to $8.73 for early 2025. But look, this cut was absolutely prudent. It was driven by those multi-billion-dollar litigation outflows. The new policy targets a sustainable 40% of adjusted free cash flow. That gives them much-needed flexibility to manage ongoing settlements and invest in growth.
So even with all these operational and financial shifts, how effectively is the new 3M management using its capital to generate profits? We're talking about return on invested capital, ROIC here. How's that looking?
Yeah, ROIC is indeed crucial. It tells us if the company is actually generating value from the capital it invests. Historically, 3M boasted an impressive average ROIC, often over 20%. Recently, it was 15.0% for the trailing 12 months. Other sources show a range, maybe 11.8% to 13.7%. But even at the lower end, it's still notably above their weighted average cost of capital, their WACC, which is around 9.72%.
So they're still creating value.
Exactly. It means they are still efficiently creating economic value, which is definitely a positive sign. It's also encouraging that their ROIC recovered to 17.7% in 2024 after a dip in 2022, a dip that was largely due to the spinoff accounting.
That's a strong sign of underlying health despite all the external pressures. Okay, let's move into Chapter 3, Financial Analysis. A look under the hood. Here's where it really gets interesting for anyone digging into 3M. What are the key financial numbers that paint the clearest picture of the new 3M's health?
Right. First, let's anchor ourselves again with its market capitalization, $76.70 billion. Now, when it comes to revenue growth, it's certainly been a challenge for 3M in recent years. Their annual revenue for 2024 was $24.58 billion, which indicates a period of stagnation.
Okay.
It's important to clarify, though, that the sharp 26% decline reported in 2022 wasn't a collapse in the underlying business. That was mostly due to reclassifying the healthcare segment as discontinued operations before the Solventum spinoff.
Ah, right, the accounting change.
Exactly. Looking apples to apples, their adjusted organic growth in 2024 was more modest 1.2%. So not huge growth, but positive.
So while sales have been kind of flat, are they still making good money? What about their profit margins? How efficient are they?
Yeah, despite that stagnant top-line growth, 3M continues to show impressive profitability margins, which is really a testament to the strength of their products and their cost controls. Their gross profit margin is very healthy at 41.21%.
Wow.
The adjusted operating profit margin for fiscal year 2024 was 21.4%. And for the most recent quarter, their net profit margin was 17.79%. These high margins are critical because they generate substantial cash flow. Cash that's essential not only for R&D and dividends, but crucially for those massive legal settlements.
Free cash flow truly is the lifeblood, especially for a company facing significant payouts like this. How has 3M performed in terms of generating cash, particularly with those litigation payments factored in?
Fundamentally, 3M is a powerful cash generator. Their reported free cash flow, FCF, was $4.8 billion in 2024. Adjusted FCF was $4.9 billion. What makes this so remarkable is that this reported operating cash flow for 2024 was after they made $3.8 billion in net after-tax payments for litigation settlements.
$3.8 billion out the door and still $4.8 billion in FCF.
Exactly. It really highlights this tug of war they're in. Strong underlying operations, generating significant cash, but also facing these substantial cash drains from past issues. Regarding earnings consistency, 3M generally showed pretty consistent growth until, well, that staggering loss of mega to $12.63 per share in 2023.
Yeah, that number jumps out.
It does. But again, this wasn't an operational failure. It was primarily due to massive accounting charges they set aside for future litigation settlement reserves. The rapid rebound in 2024, with adjusted EPS of $7.30, further underscores that the core business itself remains highly profitable underneath all that noise.
Okay, given all these outflows and restructurings, how stable is their balance sheet? Are they financially sound enough to navigate these ongoing challenges? What's the debt situation look like?
Their balance sheet shows, well, some areas of strength and some that bear watching. Their debt-to-equity ratio as of March 31st, 2025 is 2.72, which is certainly elevated for an industrial company. It reflects the need to manage cash for acquisitions, shareholder returns, and those large settlements. However, their current ratio of 1.66 indicates a healthy liquidity position, meaning they have enough short-term assets to tether short-term liabilities. So near term, they look okay. As for dividend stability, well, the multi-decade streak of increasing dividends is over, as we mentioned.
The end of an era.
Indeed, they've remarkably paid a dividend for over 100 consecutive years. The new 40% free cash flow payout policy is a more sustainable approach designed for the long term, given the circumstances.
So bringing all these numbers together, what does this tell us about 3M's valuation today? How does it stack up against its peers and its own history? Is it cheap? Expensive?
This is where we start to ask the big question for investors. 3M's trailing 12-month, or TTM, price-to-earnings ratio, PE ratio, is approximately 18.0. Now, that's below its 10-year historical average of 20.9. So that suggests it might be trading at a discount to its own past performance.
Okay. Cheaper than usual for 3M.
Right. Compared to peers, though, it's significantly cheaper than Danaher, which has a PE of 38.03, and Honeywell at 25.27 PE. However, it's more expensive than Carlyle, which sits at 12.99 PE. So it's a mixed bag against peers, but looks relatively cheaper compared to its own history. Now, to get a real sense of intrinsic value, we often use a discounted cash flow model, a DCF model.
Right.
This model tries to estimate a business's true worth by discounting its projected future cash flows back to today. It's about what the company can actually earn for shareholders over time.
And what does an educational DCF model suggest for 3M's intrinsic value right now, considering all these moving parts we've discussed?
Well, DCF models for 3M show a pretty wide range, and that's a critical takeaway in itself, depending on the assumptions you make.
Always the assumptions.
Exactly. The estimates can vary from a quite pessimistic $79.92 per share to a much more optimistic $174.35. Our synthesized educational estimate for 3M's intrinsic value, kind of averaging things out, falls within approximately $115 to $125 per share.
Okay, $115 or $125.
The key assumptions driving these differences are primarily the growth rate used that can range from a slight decline of negative 1.73% to a positive 4.7%, and the discount rate, the cost of capital. One model used a 7.8% cost of equity, for example. The biggest lesson here is that a DCF model is only as good as its inputs and the assumptions you bake into it, especially for a company undergoing such significant transformation like 3M.
That makes perfect sense. Garbage in, garbage out, as they say. Okay, let's shift our focus now to Chapter 4, Market Sentiment, Wall Street's View. What stands out to you about how Wall Street is viewing 3M right now? Is it consensus bullish, bearish, or somewhere in the middle?
The consensus rating among the 13 analysts covering it is actually a moderate buy, so leaning positive. That breaks down into 9 buy ratings, 2 hold, and 2 sell ratings. So overall, a cautiously optimistic view.
Moderate buy.
Okay. However, the average one-year price target is $155.83. But it comes with a very wide range, from $100 on the low end all the way up to $184 on the high end.
That's a huge range.
It is. And this significant dispersion clearly reflects the diverse opinions and the ongoing uncertainties surrounding 3M's future trajectory. It's definitely not a uniform buy signal from everyone.
That wide range signals a lot of internal debate among analysts. How has the broader media narrative around 3M shifted, especially with all the recent news about settlements and the new leadership? Is the tone changing?
Yes, the tone has become noticeably more positive, I'd say. For years, the headlines were just dominated by the PFAS litigation. It created a very negative cloud over the company.
Understandably.
But after stronger than expected first quarter 2025 earnings and those major legal settlements getting inked, you're now seeing headlines highlighting strong operational performance and resilience. It's interesting, the stock even rallied after management detailed its solid game plan for handling the impacts of new tariffs.
Right, we'll get to those tariffs.
Yeah, it shows the market really rewards clarity and proactive risk management, even when facing headwinds. It suggests some growing confidence. Looking at other market indicators, short interest in 3M is quite low. It's just 1.84% of the float, especially when you compare that to 5.82% for its peers.
Interesting.
This suggests that sophisticated investors, the smart money, aren't aggressively betting against the stock, which is generally seen as another positive signal. Technically, 3M's share price of $142.51 is just slightly below its 50-day moving average of $142.83. So that indicates kind of neutral short-term momentum. But importantly, it's trading above its 200-day moving average, which is approximately $140.59. And that's a classic technical signal of a potential long-term uptrend beginning.
Okay.
It certainly hints that the worst may very well be in the past for 3M's stock performance, at least technically.
That's a good technical signal to note. Okay, let's move on to Chapter 5. Ownership structure. Who owns 3M? When you dig into who exactly owns a piece of 3M, what does that ownership structure tell us? Does it signal confidence or maybe potential shifts in investment strategy?
Well, it's largely owned by big money, by institutional investors. They hold a significant portion, somewhere between 65% and 72% of the company. The top holders are the usual suspects you'd expect. Vanguard with 9.0%, BlackRock at 7.7%, and State Street with 5.1%. Big index fund managers mostly.
Right.
But what's truly fascinating here is the recent activity from actively managed funds. For instance, JP Morgan dramatically increased their positions, showing over 111% growth in their holdings.
Wow, double down.
Yeah, this suggests a new, more bullish bet on the turnaround story actually playing out. These active managers are making a conscious decision to buy more. Passive managers like Vanguard, on the other hand, had only minor reductions, which were likely just routine rebalancing of their index funds, not a specific bet against 3M.
That's a powerful signal from the active managers. What about insiders, the company's own executives and directors? Are they putting their own money where their mouth is, buying shares?
Insider ownership is actually very low, just 0.08%. Recent activity shows more shares sold than purchased by insiders. However, it's crucial to understand that many sell transactions are often from executives exercising stock options, for compensation or tax purposes.
Right, not necessarily a bearish signal.
Not necessarily. But the flip side is the lack of significant open market buys from insiders. That is maybe a neutral to slightly negative signal. It suggests they're not seeing a compelling undervalued opportunity in their own stock right now, at least not enough to buy large amounts with their own cash. Overall, 3M's ownership is quite diffuse. The top 10 institutional holders own less than 5% combined. And a significant portion, about 26.6%, is held by the general public and retail investors like you and me.
Okay, now let's connect all this to the bigger picture and dive into Chapter 6. Risk assessment. Navigating the headwinds. What are 3M's key internal strengths and weaknesses? And what are the external opportunities and threats they face as they try to execute this turnaround? A SWOT analysis, basically.
Exactly. A SWOT analysis provides a really clear, concise picture here. For strengths, 3M has that highly diversified portfolio we talked about, a strong global presence, powerful brand equity, that formidable intellectual property moat, consistently high profitability, and a deeply ingrained innovation culture. These are durable, significant assets.
Move to core strengths.
Their weaknesses include that sluggish top-line growth we've seen, a complex organizational structure that can sometimes hinder agility, a high dependence on cyclical industrial markets, which can be volatile,
Right.
that significant reputational damage from past litigation, which still lingers. And surprisingly, weak inventory turnover compared to some peers, which can tie up capital unnecessarily. In terms of opportunities, there's significant potential for expansion into high-growth emerging markets where they might be underpenetrated. They can really leverage their massive R&D for secular trends like EVs, industrial automation, sustainability solutions.
Good trend.
Huge trends. Strategic acquisitions could also play a role down the line. And they aim for margin expansion internally through their 3M Excellence program. Plus, there's growth potential in adjacent areas like healthcare tech and sustainable products. Finally, the threats. These are substantial. Intense global competition, volatility in raw material and energy prices, potential for global supply chain disruptions. We've all seen that recently. The ongoing financial drain from litigation, even with settlements, will continue for a while. Evolving environmental regulations, potential macroeconomic downturns, and of course, geopolitical events. It's like a complex landscape out there.
Speaking of geopolitical events, what's the tangible impact of those new U.S. tariffs of 2025 that 3M has been discussing? This raises an important question about their adaptability, doesn't it?
It absolutely does. And 3M has been remarkably transparent about this, which is good. They estimate these tariffs could have an annual financial impact of up to $850 million.
$850 million, that's not small.
No. They calculate it could reduce their full year 2025 EPS by 20 to 40 cents. That's a significant potential hit to the bottom line. However, management has articulated what they call a solid game plan to mitigate these costs. They plan to shift production between their 110 global facilities, optimize logistics, alter production processes where needed, and implement selective price increases. The market actually rewarded their proactive communication on this. They saw it as competent risk management, which again speaks volumes about how investors might be viewing this new leadership team. They're facing the issue head-on.
That proactive approach clearly resonates. Okay, so let's bring it all together now in Chapter 7. Conclusion. After this deep dive, what are the key bullish arguments for an investor considering 3M? And conversely, what are the most significant remaining hurdles to the core bear case?
Okay. The bull case for 3M is fundamentally built on the premise of a successful turnaround. The key points are, you've got the new, experienced CEO, Bill Brown. That, combined with the Solventum spinoff, creates a leaner, more focused, and potentially more agile company. Crucially, the litigation cloud is lifting. Those major settlements remove a huge amount of uncertainty that has weighed on the stock for years.
Right, that's a big one.
It is. And what remains is a durable and profitable moat underpinned by powerful brands, over 125,000 patents, and strong economies of scale that continue to support impressive profitability. Finally, there's the potentially attractive valuation. The stock currently trades below its long-term historical PE average. That could offer an entry point for patient investors who believe in the turnaround. However, the bear case highlights significant remaining hurdles that an investor absolutely cannot ignore. The most prominent is the growth conundrum. Can a company of this immense size genuinely re-accelerate top-line growth in these often cyclical industrial markets? That's a big question mark.
Tough to move the needle at that size.
Very tough. Second, while the major settlements are agreed upon, certain cash outflows from that litigation will still drag on free cash flow for years. That limits other investments and could potentially slow down their transformation efforts. There's also considerable execution risk. Implementing widespread changes in such a massive global organization is a monumental task. There's no guarantee of flawless success.
True.
And finally, those macroeconomic headwinds pose a significant threat, given 3M's high exposure to global economic cycles, inflation, and interest rates.
So if we connect this back to the bigger picture, and especially back to our opening question, how does 3M's current share price of $142.51 compare to that estimated intrinsic value range we discussed earlier?
Yeah, that's the key takeaway.
Right.
Our educational review of those DCF models suggested an intrinsic value range of approximately $159 to $125 per share.
Okay, $115 to $125.
3M's current share price of $142.51 is trading above this estimated range.
Above it.
Yes. This really suggests that the market may already be pricing in a successful turnaround and a comprehensive resolution to those major headwinds we talked about. An investment at today's price is effectively a bet that the optimistic scenarios will play out and that the new management team can execute its ambitious plan flawlessly to justify that premium to its estimated intrinsic value. So this raises an important question for you, the listener, to really consider. What do you have to believe about 3M's future for today's stock price to truly make sense in your investment thesis? What needs to go right?
That's the critical question. If you enjoyed this deep dive and found it valuable, please like and subscribe to the StockAnalytics.ai YouTube channel. And remember, members can add stock suggestions for future deep dives right there in the comments. We prioritize those. Plus, members get additional and exclusive videos every single day.
And as always, please remember, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Until next time, keep digging deeper into the science behind the stock.